Hello everyone, we are back. This is the second video wherein we are discussing the CMA final costing concepts. This is useful exclusively for CMA final, but if you happen to be a CA final student and you want to explore more different types of questions, you can watch this video. Let's start. As this is a revision video, I would suggest that we'll not be spending more time in doing the calculations or looking into the question and solving the answer. So it is suggested that you keep your study material in front of you. Yeah, so the next concept is cost quality management. Like for any organization, especially for a manufacturing entity, they will have a different types of cost. So how you maintain the quality, at the same time you reduce your cost, that is where your cost accounting skills or the concepts will come into picture. So here for cost cost reduction methods, there are 4 different types wherein we incur the cost to reduce our cost and maintain the quality. One is cost of control. Here it is ensuring failure do not happen. So for a manufacturing entity, assume like that, so we are incurring certain cost in order to avoid us from making any mistakes. Like if there is a worker, if I don't give him a proper training, he might end up producing defect products. So I am doing, or I am incurring all that cost in order to avoid failures, in order to avoid wastages, in order to increase the efficiency. So all the things that I'm incurring to avoid any failure will come into cost of quality, like quality training, quality circles, statistical process control, systematic development for process, quality improvement. So all these quality related things that you are incurring just to ensure that our personnel are well trained, our systems is well structured, and the process is well designed, so that we don't end up making any losses or producing scrap or unwanted wastages. Next, appraisal activities. When I say appraisal activities, this is checking for failures. So the first step was for the quality, right? So second stage, we are just checking after the production has been done. We are just checking, has this met our estimation? Has this met our standard? Was there any wrong with the raw material, or the wrong with the work in progress, wrong with the finished product? So once the setup has been done, we are incurring this expenditure, like testing and improvement of inspection of material, final product and testing and inspection, work in progress testing and inspection, packing inspection, and all these testings. So here what you need to understand here is, appraisal activities are just to check whether whatever the raw material we purchased is a correct one, how the production is going on, if the work in progress is meeting our requirement, or the final product is meeting our requirement. So we have purchased one machinery that will only test the output. So whatever the depreciation that we are incurring on that machinery will also be a appraisal activity. So in examination you will be getting roughly around 4 marks or 2 to 4 marks depending upon the examination. Next there is an internal failure and there is an external failure. So when I say internal failure, once the testing has also done, testing has been done, now we came to know that there are certain products which are scrap. So we ourselves identified, like if it's a car manufacturing entity example, so appraisal activity has been done, like the testing, quality control, everything has been done, but now we realized that a part of the end product is not correct. So instead before a customer is identifying, ourselves we are identifying, that is our internal failure. When I say external failure, we thought that's a good product and we sold it to the customer, and the customer realized at a later point of time that the product is defective. So it's coming back to us for a warranty or or replacement of something, or a damage in the public market, or whatever the damage is happening or the expenditure you are incurring post the product has been delivered to the customer, that you call it as a external failure. When it's an internal failure, so before the product is going out of your factory, you realize that there's something wrong with your production. So that is like cost of scrap, like you need to sell it sell it as a scrap, cost of spoilage, cost of rework, downtime due to defect in the quality, or retesting. So you have done the testing but you're not sure whether the product is meeting the requirement, so you're doing one more time retesting. So it's again an additional cost, but that is an internal failure. So internally the quality could not be identified at the first stage. So when I say the external failure, cost of defects discovered by the customer, so that the defect is discovered by the customer, not by us. Cost of field servicing. So field servicing ka matlab the product has been sold and the customer is complaining that there is a problem with the vehicle. So your engineering people or your service people are going there and doing the servicing. So that is also a cost. That cost is also an external failure. Cost of handling the components, warranty repairs, cost, loss to sales. So loss to sales is an opportunity, because you remember the Ola, at that time there was some issues with the EV vehicles, and somebody made some issue out of it, and people were not so interested in buying that product for some time. So that is a loss to sales. If that has not had happened, then maybe they would have sold more products, right? So warranty replacement. So we have given a warranty of 5 years because you sold a defective product, is coming back and asking for a replacement. So that is again a external failure. So this is a conceptual things. In an examination they might ask a direct question, or they might ask a numerical question, which we will be solving now. So coming to the comprehensive, so this is the question, guys. In the question only I solved it. They made a sale of 10,000 in a particular year and 10,000 in the next year also. The sales number of units are same. There's a scrap of 150. So scrap, I said internal failure. Okay, so scrap is before the product is going out to the customer, you are realizing that there is a mistake, or there is something defect, or there is a non-usage of the product. Rework. So rework is like you in testing you identified there is some problem, so you are doing the rework. So the internally we identified it, so that is the internal failure. Production inspection, appraisal. So appraisal is that you are checking whether the product is meeting its requirements. Product warranty. Warranty bill, so like once we product has been delivered to the customer and the customer is coming back and is using his warranty, so that is your external failure. Quality training, cost of control, material inspection, appraisal. Okay, so you just go through these concepts, you might get 2 or 4 marks. Okay, so now all these things will be your cost of your total cost, and for the next year it is for the first year 1745, the next year 1515. So there is a decrease in the cost of these things, so which means that the profitability has been increased by 230 rupees. Okay, so that is the question. Now come to the little trickier problems, that is more of a easier one. Now there is a finished goods, there is a product. For the finished goods we require raw material, which we can get it from supplier X or supplier Y. So we have an alternative vendors, we have to choose between one vendor. So one vendor is, or one supplier is supplying the goods at 180 rupees per 100 units. So you can say 1.8 rupees per unit, that's also fine. Defective is 3%. Out of my experience I can say that the guy who sends this will give a defective products of 3%. Anyway the 3% will be wastage only for me. So I need to purchase, or I need to make an order for 1 or 3, so that the 3 will be defective and remaining 100 will be meeting my requirements. Okay, that is a important thing. Supplier Y, he's selling it at 174 rupees per 100 units, which we can say is 1.74 rupees per unit, and the defective percentage is 5. So he is selling it at a better price, but the quality is not so good, so there is a defective of 5%. Assumption 10,000 units. So assuming that we require 10,000 units in a year, so you need to select which supplier is better to go with. And then what he's saying is, if undetected, so if there is undetected, like I said that 3% is a defective here, 3%, 5% is a defect, right? So if this product is defective and you are using that raw material in your end product, so the end product again will go to the customer and the customer will complain. So complain because of that, maybe there is a loss to sales or market damage, or maybe again warranty. So the defective you are selling it to the end product is not like, okay fine, anyway we sold it. No, it will come back to you in another form. Okay, so if it is undetected, you will incur 180 rupees for 100 rupees, so means 1.8 rupees per unit. Okay, so inspection cost is 24 for 100 units. So now the management is thinking, see, from one supplier there is a 3% of defect, another supplier there is a 5% of defect. Okay, so if I don't detect the defect and end up selling it in the final product, and which goes to the customer will come back, so we have to incur additional cost, which is under 180 rupees for 100 units. So why can't we have a system wherein we internally check it before the product is being delivered to the customer? So for that we require 25 rupees per 100 units. So that is maybe a manufacturing, maybe a plant, maybe a machinery kind of a thing that they are purchasing, and they are using for the testing, or maybe they are having they are hiring one more person who will test internally. For that they will be incurring 124 rupees per 100 units. Be the case, now will detect 90% of defects. Even after installing that defective machine or detecting machine, it's not that 100% it will detect. It will detect only 90%. So remaining 10% will eventually go to the customer, and then it will become again 180 rupees per 100. Okay. So the question here is, supplier X is there, supplier Y is there. Supplier X is having a defective experience of 3%, Y is 5%. But if we install a machine, that machine will detect this defects before the products being delivered to the customer. But the accuracy of that machine is only 90%. So 10% of the times that will not detect, which means that 10% of the time it will go to the customer, and it will become your again burden. So now you have to decide whether you have to go with the defective or not, the detective machine or not. So we'll go with the X. Okay. So as I said, we'll go with the only X supplier. What is the cost per unit? They said the cost per unit is 180 rupees. It's given in the question, but you have to do the reverse calculation. As I said that if you require 100, you will not be placing order for 100. You will be placing order for 103. So you are doing the reverse calculation, because you don't want that the defective products to be implemented in your final product, right? So 100 divided by 97%, because the experience rate is 3%. So divided by 97, you will come to what is the number of units you will purchase, multiplied by 180 for 100, which means 1.8 rupees per unit. So 185.56 is the cost per unit. So it's like a normal loss you are observing with the good number of units. And then the damages. Okay, so if the what will be the damages? 100 multiplied by divided by 97%. So you will know what is your original quantity that you will be placing in order, of which 3% will be wastage, as I said in the question also. And then 1.8 rupees is the damage cost. Okay, so what is this 1.8? 1.8 is not the cost in the question. If you remember in the question, if you remember, this is a cost. If it is undetected and going to the customer, you will incur 180 rupees for 100 rupees as a defective cost. So 1.8 rupees per unit. So that 1.8 rupees here. So 5.56 is for the damages that you will incur. So ultimately the cost that you are paying to supplier X is 191.13. I'll repeat one more time. I know this is very tricky or little tricky. So though I'm purchasing, I need 100 units from him, I will purchase 100 divided by 97, because I know 3% will be wastage. That multiplied by 180 divided by 100, or you can say multiplied by 1.8. So this is the cost I'm paying to the supplier, correct? But whatever it comes, of that 3% will be wastage. So whatever it comes is this much, 3% is a wastage, this much, that will go to the end product, and that will become a burden for me eventually. So again 1.8 as a defective cost. So 5.56. So I can say that 191.13 is effectively I'm paying to vendor X. Okay, supplier X. Now coming to the Y, here his experience is 5%, right? So 100 divided by 95%, you will know what is the quantity you will purchase, multiplied by 1.74, that is a cost per unit that you are paying to him. So 183.15 is effectively you are paying to supplier Y. But again there will be damages. The damages 100 divided by 95, so you will know what percentage, what quantities you will purchase, multiplied by 5%, you know what is the damage, what is the number of units that go into damage, multiplied by 1.8 is a defective cost, multiplied by 1.8, so 9.47 is the damages if you are purchasing it from supplier Y. So 192.263. So you will say supplier X is little bit better because he is offering it a lesser. Okay, but why the question is not only whether to choose supplier X or supplier Y. For first part of the answer, that is fine, question, that's fine. But for the second part, they are saying if you install that detective machine that you said will detect 90% of the defects, right? So if that is the case, if you consider detective machine 100 divided by 99.7, so what is this 99.7? Listen here, 100 you are ordering, 3% is your experience, so 3 will be the defects. I know sir this one, so this will be 97, but out of these 3, 10% only the detective machine cannot detect, which means out of 100, 0.3 is only that will go into defect. I have not understood. Listen carefully. If I am ordering 100 quantities, 100 may he will deliver only 3 products as a defectives. Understood, sir. So out of 3, when this detecting machine tries to detect it, it will detect only 90% of the times, which means out of 3, only 0.3 only will be my defectives, because the remaining 2.7 it will detect it. So now my damage is 100 minus 0.3. So eventually I will be getting 99.7 as my good number of units. So again, same whatever the workings I have done, replicating here also, 100 divided by 99.7. So that will give the number of units I will be purchasing. Cost per unit is 1.8. So 180.54 is a cost per unit I will be paying to the supplier X. Again, the damage is 100 divided by 99.7. So we'll know what is the number of units I will be purchasing, multiplied by 0.3. What is the 0.3? Just now I said it. Of 3, only 0.3 will not detect it, and multiplied by 1.8, that is the damages. So 0.54 will be the damaging cost if I install the defective detecting machine. Sir, what is it, sir? Even if you are installing the detective machine, still you are having the damages. Yes, the accuracy of the machine is only 90%, right? So 10% of the time still you will incur some damages, that is 0.54. And then the improvement, like for installing or for operating that detective machine, we will be incurring 24 rupees. Okay, so total it is 205.05. So I would say that it is better to not have a detective machine here, because the cost is more. Okay, it's fine that we have some damages, but don't go with the detective machine for the financial prudence. Okay, so that is one question. We'll go to the next one. There is a company, Rax Limited. They are making a sports shoe, and for sports shoe they will be selling in pairs. So for internal inspection they will incur 30 rupees per unit. For rectification or rework, 18 rupees per unit. Okay, for inspection ka matlab whatever the units that come out, each unit they will test, check. For that 30 rupees they will incur. Fine. If they find out any product is defective, that only will be reworked. Okay, so if I'm manufacturing 100, so 100 I will inspect, that's fine, but the rework I will not do for 100. Maybe out of 100, if there are 2 defectives, only for defective products I will be doing the rework. Okay, so with that understanding, they have given some numbers. We have to tell what is the total cost. So number of units manufactured and sold is 60,000 in a year. After inspection, defects are 5% of output. So out of to find out which is a defective products, first we need to do inspection. So for after inspection, we like 30 rupees per unit you will incur for inspection, and in that inspection you identified that 5% of the output is defective products. That's fine. So that and after sales means, once you identified something are defective, you rework it. Fine, you will rework, and then once the rework is done, then the quality is as good as any other product. So if you're getting a shoe, maybe that shoe is a defective shoe which is identified by the company internally, and they have done the rework, and now it looks like any other shoe. Okay, so don't think, sir, our output is 60,000 minus 5% is a defective, so remaining only will be sold to the customer. No. Once it is identified as a defective, still they are doing the rework, so they are making it as good as any other product. It is invisible for us, and then then entire 60,000 they are selling it to the external market. Of that, 6%, 6% will be the defectives identified by the customer. So it's like you are selling to the customer, and the customer then realizing that sole is not good, that this is not good, color is going out or something, they are not happy. So 6% of the output they are identifying it as a defects. So once you identify it as a defect, they have to bring it back. So 10%, 10 rupees per unit is a transportation cost that the company will incur. Sometimes we say it, right, like what do you call it, return. Okay, so this company might be giving that. And the negative publicity is 5% of the external failure. So see, if there is an external failure, like which is 6% of the output, and if I say that the product is not good, sir, so they will replace it. So if I replace it, some people say, okay, the company is good that they are replacing, so I'm happy with that. But some people say that, okay, this is the company, is a waste company, you see what kind. So he will not remember what is the latest product he got it. Again, he'll remember the original product he got and say that the company quality is not good. So because of that, there is a failure, there is a negative publicity in the market, and 5% of the external failures will be considered as a lost sales in the future. Now analyze the cost of quality. So now in order to maintain the quality, what are the different costs that you are incurring only for quality purpose? Okay, so now the question is very simple. I think if it comes for 4 marks, you will get it very easily. But first understand, first we are doing the inspection. First we'll do the inspection, right? Once the production has been done, first you do the inspection. Okay, so inspection is 30 rupees of output is 60,000. So inspection cost is I'll write it here, 60,000 output multiplied by 30 rupees. So once then done the inspection, you will identify there are certain defects. The defects are 5% of the outputs. Okay, 5 multiplied by 60,000, so that will become internal inspection, 60,000 multiplied by 5%, and you will incur 18 rupees for the rework. Okay, so whenever once the inspection has been done, there are certain defects. The defects are 5% of the output. So 60,000 multiplied by 5 will give certain number will come. That number is a defective. For each product you will incur 18 rupees. So this will be your 2. Okay, so that is inspection. And then after sales 6% of output. So 6% of output also again it is 60,000 only. Don't do that net because it is made as good as the original product. So external external के लिए 6% of output. So defects are 6% of output. Once the customer identifies output, it has to come to the factory. So 60,000 multiplied by 6%, you will know what is the number of units they are defects identified by the customer. So to bring that to your factory, 10% will be your transportation cost. So 36,000. This will be third one. Okay, and then there is a bad publicity. The bad publicity is 5% of the external failure. So total you sold 60,000 units, right? 60,000 में 6% is a defects identified by the customer, and of which 5% will create the bad publicity. So this is very important. 60,000 is the external number of units you sold, of which 60% is a defective, of which 5% only are complaining and creating a bad publicity, multiplied by your only contribution. Okay, so in the question they have given, in the question did they give or did I not write it? Yeah, so in the question okay, I did not write I think in the question they have given selling price. So they have given the selling price, they have given the variable cost. So now we will know what is your contribution, that is 40%. just check it from your end from the question. So 600 rupees is the selling price, 40 is a contribution. So you will only take the contribution as a lost sales or bad publicity, not the entire sales price. That is more important. Only the contribution percentage. Selling price say like multiplied by contribution percentage. So only the contribution amount you will take. 60,000 units you sold it in the external market, of which 6% are the defectives, identified them, of which 5% are creating the bad publicity, multiplied by contribution. So total 19,98,000 is the total quality cost of this company. So totally they are spending more on the inspection only, remaining all are little negligible. Okay, so they are asking another question in the same another part in the same question only. What is the profitability? Sales, they have given the selling price and units. So sales variable cost is given in the question only. Contribution, fixed cost, and then quality cost 19,88,000, and then profit. So remaining things are easy only, like you can do it on your own. The only thing that you might forget or might not consider just by mistake is this quality cost, whatever you incurred, that should also be deducted from your profitability statement to get the profit. Okay, so I don't have the question. I think I just missed writing that part of the question. Sales are given, variable cost is given, contribution, fixed cost is given. Now only the quality cost is what we have identified here, and which needs to be deducted from your contribution or the profit. So then you'll get the net profit after the quality cost. So now we are going to the next part, that is the decision making techniques. So when I say decision making techniques, this is a very lengthy chapter and it will have a lot of questions. There is a illustration 1, computation of break-even point and profit planning. There is a company who is having a net revenue of 80 lakh, and expenditure is including 40 lakhs fixed, so 88 lakhs. In the question only, see, while reading the question, our mind should keep reading the hidden information of it. So they are saying the expenditure is 88 lakhs, of which 40 lakhs is a fixed cost, so which you can say that remaining 48 lakh is your variable cost, which might be useful for us in calculating the PV ratio. Okay, so net revenue is given, expenditure is given, net loss they are getting of 8 lakh. Now the question, they are making a plan, they want to incur some 20 lakh rupees additional expenditure, and with that they want to understand what is the break-even point. So for calculating break-even point, the concepts are same. Like if you have watched my earlier video or every video, I keep telling sales minus variable cost, contribution, PV ratio, break-even point, the structure should be like very intact. Sales is given 80 lakhs, the same thing I'm considering here. Variable cost 48 lakhs, which we derived indirectly. Total cost is given 88 lakhs, fixed cost is 40 lakhs, so remaining 48 lakhs is a variable cost. So you got a contribution, so you got a sales, contribution, sales, you both you got it. So you are getting a PV ratio of 40%. I need not tell you what is the formula for that. So you know the PV ratio is 40%, and you will know what is your break-even point. So break-even point. So break-even point ke liye what is your fixed cost? Fixed cost, it's already given 40 lakh, and now they are planning to incur some expenditure to increase the sales or something like that. So they are increasing the advertisement expenditure or some expenditure by 20 lakh. Already it is 40 lakhs, so revised fixed cost is 60 lakhs, and the break-even point or break-even sales formula is fixed cost divided by PV ratio or contribution per unit, as a case may be. So now it is 60 lakhs divided by 40%, so 1.5 crores will be your break-even sales. Okay, so now in the same question, there is another bit what they are saying is, if I want to have a profit of 4 lakh, what should be my sales? So the formula is same. See, if break-even point, what did the formula, what formula did we write? Fixed cost divided by PV ratio, right? Because our intention was only to recover the fixed cost. That is what we call it as a break-even point. So whenever you require some profit, you add some profit here, that the desired profit, whatever the desired profit, that's it. Okay, the formula is very simple. Break-even point ke liye whatever is the formula, for that you add the desired profit. So break-even point 60 lakhs, we already got it. What is the fixed cost for fixed cost? 60 lakhs, and now they are expecting, or they want a profit of 4 lakh. So 60 lakh plus 4 lakh divided by 40% is the PV ratio. Just now we got it above. So 1.6 crores is the desired sales for them to recover a profit of 4 lakh. Otherwise you can say that 4 lakh divided by 40%, so that will get the margin of safety plus break-even point. So again, that will create complexities. If you are fine, you can use other formulas also. Especially for marginal costing, there is nothing like you can solve a problem in a particular way. You can solve these questions in as many ways as possible. It's just that you need to be strong or clear with your concepts. Next question, the question is relating to accept or reject. You just need to accept an offer or reject one offer. So there is a company who is selling in the domestic market and whose capacity is 80%. Like at the moment they are operating at an 80% capacity. So they received one export order. The order will have 40% capacity, which means I am having a plant here and I'm manufacturing something. So I am utilizing 80% of my existing capacity. That's clear, right? Which means that only 20% is idle. Now I am receiving one export order. What they are saying is, if you want to accept my export order, I would require 40% capacity. So already 80% I'm using, so only 20 is left. But now I need to make a decision. Should I accept that 40% and forego 20% in the local market, So that is the question. Okay, these kind of questions you can expect. Now if you were to accept this offer, you need to sell this product at 10% below the domestic price. Okay, so if you are selling a product in domestic market like in India at 100 rupees, you need to sell the same product in the export, like for this particular market you will be selling it at 10% below the domestic market price. If I'm selling it if I'm selling this at 100 in India, I should sell it at 90 in domestic market, or you reject it. Okay, you either accept or reject, don't discuss more. Okay, now they have given some more information. See, the question is given in a very lengthy way with a lot of sentences, lot of grammar and all. For simplicity and for all our revision purpose, I just made sure that I write only the numbers point. Okay, if someone wants to understand the crux of the question, if I'm making any sense, open the study material, read the question in front of me, or before I solve the answer, then it will be very clear. So the question, they have given some more information, like sales is given for existing 80% capacity. What is the sales? Direct material, direct labor, variable overhead, fixed overhead, everything is given. Alternative number 1, continue the domestic and reject the export. They are saying, I don't want your export order, reject it. So what if I reject, what is my profitability? Which means that what is your existing profitability? It's as simple. Instead of saying what is their existing profitability, they are saying alternative number 1, reject the export order. If I reject the export order, existing capacity is 80%. So if I run with the existing 80%, what is my profitability? Already information is given. Without using the calculator, you can do it, but in examination you need to write, right? So sales 16 lakhs is given, direct material, direct labor, variable overhead. So you just again have the same pattern, whatever the question, don't deduct everything like that. Sales minus variable cost, you are getting a contribution. Fixed cost 5.2, you are getting a profit of 2. So if I reject the export order, then I will be getting a profit of 2. That is the alternative number 1. Alternative number 2, accept the export order. You see, if I accept the export order, there is a one trickiness here. If I accept the export order, I will not be selling my existing capacity in the domestic market. Earlier I used to utilize 80% of the capacity and make some sales. I don't know the number, but if I accept the export order, I need to sell only 60%. Okay, out of 100 I will be utilizing 40% for export order, remaining 60% only I will be utilizing in the market. That's the only thing you need to keep in mind. So sales there are two types of sales, one is domestic, one is export. So domestic you do the reverse calculation. For 16 lakh sales, existing sales, I am utilizing 80% capacity. 16 lakhs divided by 80%, I will know what is my 100% capacity, multiplied by 60%. Why? Because I will be utilizing only 60% of the capacity. This is very basic. So 16 lakhs divided by 80% will give me the overall capacity, multiplied by 60% will give me the 60% capacity, because I will be utilizing only 60% of my capacity, because I am accepting the export order, multiplied by 100. So this will be 12 lakhs. That is not required, but I'm just writing it for understanding. So so 12 lakhs will be my sales, domestic sales. Export sales 16 lakhs is for 80%. So I will know what is my 100% multiplied by 40%. Why 40%? 40% because the export order will consume 40% of my capacity, multiplied by 90%. Why this 90%? I did not understand. 90% because this is a selling price. I will be selling it at 10% lower than my existing market. So I will be multiplying it by 90%. Okay. So I will be getting 7.2 lakhs. So 19 lakh 20,000 is a total sales, including my domestic and export sales. Now variable cost. So variable cost, a little careful you need to be. So here 5.8, 2.4, 0.6, so 7.2 is already given. So that much of the cost I was incurring for 80% capacity, divided by 80%, multiplied by 100%. I will know what is my 100% capacity. So this is my variable cost. Sir, what about the 40%? You don't segregate what is variable cost for export, what is the variable cost for domestic, because the number of units are increasing, so variable cost will increase. The very nature of the variable cost is that it will increase or decrease depending upon your production. So simply whatever the existing variable cost divided by 80% multiplied by 100% will give the 100% capacity. If you are operating at a 100% capacity, which the company is doing at the moment, what will be your variable cost? So 11 lakhs will be your variable cost. So this will be your contribution, this will be your profit, sorry, fixed cost given in the question. Profit is 3 lakhs. So now if you are operating at 80% capacity without accepting the export order, your profit is 2 lakh. If you are accepting the export order, your profit is 3 lakhs. Okay, this is the option number 2. So what is the alternative, or alternative 3? Alternative 3, increase the capacity. Say in the option number 2, what we have done, we have forgone 20% of the domestic sales. You forgot our own motherland, like where you are selling earlier, your base location. Just because you got an export order, you are so enthusiastic and you accepted the order, that's fine. But if it doesn't come in the future, then the market will be captured by someone else. So then in the future, you will not be again going back to 80% capacity. Okay, that is a management or business decision. Now they are saying it's okay, I don't want to forgo this. I struggled a lot to get into this stage, so I don't want to struggle and leave the 20% market share to the open players. So I will increase my capacity. If I have to increase my capacity, I will be incurring 65,000 rupees as an additional fixed cost. And labor also, they will be working more. Earlier they are working at 80% capacity, you are paying for 100% of their capacity, like they are idle for 20%. But you cannot say that, okay boss, you are idle for 20%, I will give you less wages, or you will be giving for 100% only. But now 80% domestic, 40% exports, so total 120% is a total 120% capacity you are operating. The labor will have to work more, so they will say that we need 10% additional as a OT, because we are for 20% extra, I want a 10 as a OT. Okay, only 10, they are not asking like double, only 50% extra they are asking. Okay, so now with this alternative, this is very important in the examination. Sales, domestic sales, you will make domestic 80%. Earlier 16 lakhs you made, now same sales, because you are not foregoing any market share. And the export 40%, 7.2 lakh, we already got it. So I'm not doing the calculation again, and in fact you should also not be doing the examination and waste the time, and at the end say that my time was not sufficient. So 23 lakh 20,000 is the total sales, including domestic and export. Coming to the variable cost, little careful is required. So 80% capacity, 8 lakh 80, we already identified 8 lakh 80. Where did we identify? 7 8.2, 8.8. okay, so already identified 8.8. so 8.8 is a domestic variable cost given in the question. Okay, and for export 40% divided by 2, also you will get 4.4. very simple, variable cost will increase or decrease with the number. Only exception is OT. Okay, so OT for 10% additional we need to pay. For 20% additional capacity, 10% we are paying. Okay, so 2.4 lakh in the question they have given direct labor is 2.4 lakh for 80% capacity. Okay, so 2.4 lakh divided by 80%, you will know what is the 100% capacity, multiplied by 10. Okay, so multiplied by 10%, because additional, and they want half, 50% of it. Okay, so for that 15,000 will be the additional OT we will pay to them. Read the question once again. As I said that I did not write it completely, only the numerical things I have taken. In the question they said that for additional capacity, OT will be given at 50% for the additional things. Okay, so only for 50% we will be taking here. So someone might ask a question, sir, additional capacity is 20, so you are taken 10, so there is 50%. but why this 50%? The reason is, for additional, see, if I am working more, my salary was already included in this, right? See, if I say 150% of 100, so 150 may 100 was included in this labor, 50 is included in this labor. So that is the reason why this 50 is coming by 2 times. One is my main salary was already included in the normal variable cost. This additional 50% is only for the OT. Okay, don't get confused here why I am writing 2 times. So that way your fixed cost already given to 5,20,000. because of increase in capacity, maybe they are planning additional space, they need 65,000 more, so profit is 4 lakhs. Out of these 3 options, which one is better? Option number 4 is better. You increase the capacity and accept the export order without foregoing any market share in the domestic market. So that's illustration 2. So we are going to illustration 3. These are all very interesting questions, guys. Like if we have to explain this in a very lengthy way, each one will take one hour more, one hour very easily, but it will give proper understanding of the subject. But because we are in a revision mode, so I'm going little fast. Hope you understand that. So now limiting factor and optimum mix. This is also kind of an important question. Limiting factor, understand the crux of the question before solving itself. See, in for any manufacturing unit, I will have some machines, I will have some labor, I will have some material. So just because my Excel sheet is saying I cannot do any production as the case may be. I need to see what is the maximum available machine hours, what is the maximum available labor hours, what is the maximum availability of that particular material. Should I use that material in product X or product Y or product Y, product Z? So these decisions will depend upon which is a limiting factor, like which is a particular thing that will, on which you will base your decision. If my machine hours is very limited, like I have 4 machines that can produce this many number of hours, now that 4 machines can produce A, B, C, D, anything. So now should I go with A, should I go with B, should I go with C? There is an endless limit of demand in the open market. There is a demand, but which product should I decide, should I manufacture? That will depend upon what is the contribution you are getting of each unit. Generally we calculate contribution per unit, right? But in this case, whenever there is a limiting factor, whenever you are calculating or finding out what is your optimal mix, you need to identify what is the contribution per whatever is the limiting factor. If it is if the machine hour is a limiting factor, you need to find out what is the contribution per limiting factor. If the labor hour is a limiting factor, you should say what is the contribution per limiting contribution per labor hour. If material is limiting factor or whatever, whichever is the limiting factor, that needs to be the basis to take the decision. So with that said, we'll start one question. There's a company who is manufacturing A, B, C, 3 products. Okay, these are all questions, not answers. Sales are given, number of units, selling price is given, cost is given, processing time per unit 1 hour. So they are saying processing time, which means that itself is a limiting factor. So demand is also given. So there is a ample demand in the market. Now full capacity is 13,500 hours in a year. So maximum you can utilize 13,500 hours only. You need to decide in which proportion you will sell the product ABC, or you will manufacture product ABC, so that you get the maximum profit. As I said before starting the question, only any question which comes in this way, first calculate what is the contribution. For that you again go with selling price minus variable cost, you will get the contribution. That is the basic structure that should be there in your mind while you are taking this costing examination. Selling price is given 20, 31, 39. Unit price is given 18, 24, 30. So you know what is a okay, one point I did not mention. Yeah, so fixed manufacturing overhead is 200% of the variable cost, which means here they have given cost, right? This cost 18 rupees, whatever they said, that is inclusive of fixed manufacturing overhead of 200% of the variable cost. If the variable cost is 100 rupees, fixed manufacturing overhead is 200% or 200 rupees, so unit cost is 300. So I did not get. Again, listen properly. For product A you take 18 rupees they are given, right? So they are saying 18 rupees is inclusive of fixed overhead. Sir, what does it mean? Which means that while calculating contribution, do you consider fixed overhead? You will not consider. So you will take only the variable portion. So 18 may, I can say 6 is the variable portion, 12 is the manufacturing overhead, 18 is the total cost. 100 multiplied by 200%, 200, 300%, right? So now I will consider only the 6 rupees. That should be the case. Now here it is a cost, they just said cost, they did not say it's a variable cost, right? So you are eliminating fixed portion from this by understanding this fixed manufacturing overhead is 2% of the variable cost. So 6 rupees, 8 rupees divided by 3, boss. Okay, very simple. So 18 divided by 3, 24 divided by 3, 30 divided by 3. Okay, so you got the variable cost, you know the selling price, you know the variable cost. Now you know what is the contribution. 20 minus 6, 14, 31 minus 8, 23, 39 minus 10, 29. So this is a variable cost per unit, but we don't require per unit, right? We require per processing hour. So how many hours you will take? You will take 1 hour, 1 hour, 2 hours for each product, right? So divided by 1, divided by 1, divided by 2. So which means that contribution per hour is 14, contribution per hour is 23, contribution per hour is 14.3, 14.5. So now you can understand which is the most beneficial for you. Which is most beneficial? It is giving 23 is giving more contribution per number of hour. Okay, if I manufacture this particular product by using 1 hour of this machinery, I am getting 23 rupees. So that is the most profitable, boss. So you go ahead with that. So ranking is 1. Next best is 14.5. The ranking is 2. So next best is 3. Ranking is 3. So you can say, sir, 23 is better, no, sir, best, no. You can come, you can manufacture only the product to be, boss, correct only. But is the market ready for that much? Market is only for 8,000 units. So just because it is giving more contribution doesn't mean that you sell only the one product, right? You'll see what is the market demand also. So that is the reason why we will calculate what is the ranking. So once you calculate the ranking, now you go with the mix. Okay, so optimal mix. So demand is there, demand 11,000, 8,000, 2,000 demand. Question may, it's given in the question, so just writing the question only. And you know how many hours you required? 1, 1, 2. For one unit you require 1 hour, 1 unit 1 hour, 1 unit 2 hours. So you require 11,000 unit hours of A, 8,000 hours of B, 4,000 hours of 3. Okay, you know what is the ranking? 1, 2, 3. Just now we gave the rank. Now you need to allocate. Here you pay the attention, you pay attention only for one question, remaining you can do it on your own. So available is 27,500, 13,500. See, for machinery 13,500 hours are available. Which is the best one? First one is best. So you give maximum hours. So maximum what is needed? 8,000. So you give 8,000 for the product B. Remaining best is C. How many hours it requires? 4,000. You give it full 4,000. So you have given already 12,000 out of 13,500. You are given 8,000 to B, 4,000 to C, which means that remaining 1,500 are left. So you give it to the least important, is the product A. So in that way, how many units you will produce? You are given only 1,500 hours, right? So each requires 1 hour. So you will produce only 1,500 of A. 8,000 you are given it to B, which takes 1 hour. So 8,000. C, it takes 2 hours, 2,000. Okay. So which means product A you will produce 1,500, product B 8,000, product C 2,000. And the contribution per unit is, we already calculated what is the contribution. So we know what is the contribution, you just multiply. So you will get the total contribution of 3 products, and you know what is the fixed cost, that is also given in the question, and you know profit. So in the costing, everything is there in bits and pieces. You just need to pick up, and first before picking up you need to understand what you require. I require to select which is the best product for me. In order to find out which is the best product for me, I need to find out what is the contribution per unit. So sales minus variable cost. If the question is given total cost, just eliminate the fixed portion, just take the variable portion. Sales minus variable portion will give me the contribution. Contribution divided by how many hours each unit will take. So in that way I will find out what is the contribution per hour. In that way you will find out what is the ranking. Best ranking, you give the more hours depending upon the demand. Maximum demand, you try to meet the maximum demand. Then go with the next best maximum demand. And whatever the remaining hours you left with, you go with the least important product. So that way you will find out how many hours you are giving it to each product, and that way you will find out how many units you will produce based upon the number of hours you have given. So you will find out what is the total number of hours, total number of units you will manufacture, and you will also have the contribution per unit we already calculated. So number of units multiplied by contribution per unit, you will give the total contribution minus your fixed cost will be given somewhere in the question. You need to search somewhere, or you need to write it in your answer. You will get the profit. Okay, so that is a product best mix question. So now we have another interesting question. Illustration 4. There is a open area or land which is 96 hectares. They want to manufacture, or they want to cultivate 4 different products. Okay, royal red, golden yellow, juicy, crisman, sunny scrap. Okay, whatever. So there are 4 different crops they can make. So 68 acres or hectares. For 68 acres, that can be used by any product. So this is feasible, or this is, you can manufacture, you can cultivate any product here. But for 28 hectares you can cultivate only B or C. Okay, so if I say A, B, C for simplicity, you can use it for B and C only. For A and D, it is not feasible. Okay, so now they're saying for to maintain the portfolio, you need to have minimum production of 100,000 boxes of each product. Minimum, that much is required. Even if that product is making a loss, I'm fine, but still we need to have manufacture 1,000 boxes. So they have given fixed overhead per annum, growing के लिए 1,12,000, harvesting 74,000, transportation 72,000, administration 102,000. So total 3,30,000 is the fixed expenditure you will incur. And the question they are saying is, what is the product what is the product preference? Which product should I go with? It's a preference. They're saying the ranking in another way. What is the optimum mix? This is a question. So be the question whatever the way they ask. Maybe it's a manufacturing, maybe it's a servicing, maybe it's a hospitality, or whatever the industry that they are in, first identify what is the contribution per unit. Okay, what is the contribution per unit? That is that way you can go with the that way you can go with the preferences or ranking. And they also mentioned 27,750 boxes of any one quantity is a maximum production. So minimum we need to maintain 1,000. Minimum we need to maintain 1,000 boxes of each product, even if it is making a loss, that's fine. But maximum is 22,750 of any. So you don't go beyond that, because we will not be selling that product. Okay. So now with that we just put it in a proper table so that to make it easy. 350 is the annual yield per acre. Annual yield 350. Direct material they are incurring 4760, 2160, 1960, 3120. So that is the direct material per hectare. Labor cost they have given growing, harvesting per box, transportation per box, growing per hectare. So certain information they are given per hectare, certain information they are given per box. Don't get confused with that. We always go with one particular measurement. If you are taking per hectare, everything should be at per hectare. So market price is also given. So question doesn't seem to be difficult, but it is lengthy. I accept it. We need to solve once at home before going to the examination. That's fine. The basic thing, they are given the market rate. They are given what is the minimum rate, minimum quantity you need to produce, what is the maximum quantity you can sell. Remaining costs they are given in different propositions. So now, as I said, for any preferences you will make it for any preferences you will find out what is the contribution per unit. Sales, they have given selling price 153.80, 158.70, 183.80, 222.70. I'm not reading the numbers, but try to understand. For contribution, what you required? Sales value. For sales value, what you required? What is the selling price per unit? And for each hectare, how many units you will produce? Okay, so for each hectare they will produce 350, 100, 70, 180. So that is a per hectare sales quantity, and each quantity you will sell it at this price. So you are getting the total sales value. Okay, so I'm not reading, but that is the context. Now coming to the variable cost, direct material they have given 4760. 4760 is per hectare. We need not multiply with something or anything, because it is in the same unit of measurement that we wanted. So 4750. Growing 8960. Growing also is given per hectare 8960. Harvesting 12,600. So per box, so how many boxes we are? 36, right? Let me take the calculator. Eight into 100. Yeah, that is for transport. Cost. It in this transport harvesting. So harvesting is given for per box. So I'll write it here. 36 is a harvesting cost per box. They'll manufacture 350 or they'll cultivate 350. So 35 multiplied by 360, so 12,600. This is the harvesting cost. Transportation, they are given per cost per box. So 52 multiplied by 350, multiplied by 350, 18,200. So 18,200. So now we got total variable cost, contribution per hectare. You got the preferences. See, don't get scared with the lengthiness of the question. Just understand, we need sales price. For sales price, what we require? What is the selling price per box? It's given in the question. Because it is per box, we need to multiply it with how many boxes you will manufacture, you will cultivate in a hectare. So number of units, selling price, you got the sales minus variable cost. So variable cost means certain things are given in the hectare, you directly take it like that. Certain things are given per box, you convert into for 1 hectare by multiplying with this 350, 100, 70, 180. So you are getting the total variable cost. So you got the sales, you got the variable cost, now you got the contribution, and based upon the contribution per hectare, I said this is a limiting factor, right? So per hectare you make a decision. So which is most beneficial? Most beneficial is 9310, preference number 1, 50546, preference number 2, 1316, preference number 3, negative 770, preference number 4. Okay, so even though we are incurring a loss for product B or the second product, still we have to maintain cultivate 100 or 1000 boxes for maintaining the portfolio. Now that is the first part of the answer. Now come to the second part. What is the optimal product mix? Optimal, they said minimum I require 1000. This needs to be understood. Earlier question there was nothing like minimum we need to manufacture this much, but in this question it is given, right? So that is important. And the maximum they said is maximum area, minimum they want 1000 boxes. Okay, so they want 1000 boxes, but again don't forget we are dealing with a hectare, everything we got in hectare, right? So 1000 divided by 350, so they require 2.8785, so round it off to 3. So they would require 3 hectares for A, 10 for B, 15 for C, and 6 for D. Okay, so this is a minimum hectares they need to allocate to each thing. And coming to the maximum area required, so what is the maximum area? I said each product you need maximum of 22,750 divided by 350 for 1, so 65 hectares, 227.5, 325, 126.39. Okay, so minimum maximum hectares of how much we required, we got it. Now it's time to allocate. Here you pay attention, there are certain land that is suitable for all the products. Okay, so where is our ranking? I'll just write ranking here, 1, 2, 3, 4. Pay attention here. First one we are giving preference. Why? Maximum we required is 65 hectares. That's fine. Okay. So maximum we require is 65 acres, but 68 acres is suitable. So we have 68 acres. We need to allocate between A and D. Okay. It requires minimum 6 hectares. Even though it is less preference, even though it is contributing less, but to maintain the minimum portfolio of our products, we are giving 6 to it, and the entire balance is going to first one. Again, I am saying we have 68 acres. We need to take a charge. We need to decide between A and D. So D is least preferable. You can only go with A only, but they have a minimum requirement of demand. Okay, minimum maybe company's portfolio के लिए they require 6 acres of product D. So you give 6 only as much as required, that's it. Remaining all is most preferential A, so you give it to A 62. So remaining 28 acres is suitable between B and C. Okay, so B and C may, B is loss making, so you only give what is required, 10 is required. Out of 28, 10 you are giving it to B, so remaining 8 you give it to C. Okay, so it appears to be simple, but understand the concept. Now with that, we have given allocation of 62, 10, 18, 6. Contribution per hectare we identify already, you multiplied with that. That is a contribution per hectare. Now you are calculating what is, how many hectares you are allocating to each product. So you will know what is your total contribution, you know what is the fixed cost given in the question, you know what is the profit. So now this product mix is happening. Now some bank is coming and they are saying that no, why this this 28 acres land whatever is there, no, this 28 hectares, so why it is suitable only for B and C. We'll make some improvement and we will make it useful for A also. Okay, so we'll just make some additional expenditure. So they are incurring some expenditure. You read that question for more understanding if you want it in that way. So now after improvement, how we can go, just listen here. Minimum 3, 10, 15, 6. We understood from the main question only what is the minimum required. Okay, so now we need to apportion this 62, the first wala 62. So we are giving it to 62. You already gave it. Okay, so now it has become 65. Minimum 10, 15, 6. Right. Earlier how much we gave? 62. Then what is the difference here? Okay, 62 we are apportioning. I lost somewhere. Total 96 hectares we have. So 92 में we require 6, 15, 10, 3, 10. Okay, earlier what happened was, because we were choosing between only these two, so that is the reason why we gave 18 to C and 10 to B. But because of improvement, now they are saying you have a alternative of A also, because A is giving more, so you give C only what is required. We require only 15, so we are giving only 15. Yeah, it's a nice question. So we are giving only what is required. Earlier, see, before improvement, what happened? You needed to make a choice between B and C. But now because of improvement, you need to make a choice between A, B, C. Because A is more profitable or most profitable, C you give only what is, how much is ever is required. Rest all you give it to A. See, just observe this question. Minimum the required is 15, but we ended up giving 18. So 3 hectares we gave more to C, because we had to make a choice between B and C. But now we are making a choice between A, B, C, and A is most profitable. So C you give only as much as required, which is as much is only 15. So only 15. So we are giving only 15. Remaining all we are giving it to A only. So with that contribution we already find out in the above, and there is a saving of 1250. That is also given in the question. Now you know what is your total contribution. Fixed cost is given, and again the fixed cost में the interest element will increase. Some bank is offering some investment, are offering to make some investment, for which we will be paying 6% as an interest. So existing 3,60,000 is a fixed cost, plus this additional of 3,000 will come. So this will be the answer. Best product mix. Now there is one more question. The question is make or buy. So when I say make or buy, we are a manufacturing unit, we will manufacture a product. To complete that product, we might require certain other components also. So the question here comes is that should I manufacture the component also, or can I simply borrow it or purchase it from outside? So it's a decision between should I manufacturing in-house or should I outsource it from the vendor. Okay, so the question is, there is a cycle company who are making bicycle, baby tricycles. They are estimating 10,000 units will be the sales in the first year and 20,000 will be the sales in the second year. Okay, now the question is, for cycle they required a bell. So if I purchase it from the third party outsource, they will pay 8 rupees per bell. But if I manufacturing internally, I have two options. I can go with the one kind of a machine, that is Super X, another kind of a machine which is Janta machine, machine Y, for an example. So now we know what is the cost, we know what is the life is given, we know what is the fixed expenditure excluding depreciation. Whenever the question says excluding depreciation, you need to consider the depreciation also separately. So variable expenditure also given. Sir, why is so much of hangama? Now question you understand, I am a manufacturing, I'm a manufacturer of a cycle, tricycle. For the cycle, I'm estimating my sales will be 10,000 in the first year, 20,000 in the second year. That's fine. To manufacture a cycle, I require a bell. Bell is like a little complicated when I'm simply assembling or something like that. So should I purchase a bell outside and just fit it here, or should I manufacture internally, in-house? If I'm manufacturing it internally, I would again I need to make a decision. Shall I purchase that machine from X or Y? If I purchase from X, details are given. If I purchase it from Y, details are given. It's as simple as that. Now the question is, you just find out which is the best choice. If it is a 10,000 levels for the year 1 and 20,000 units and on for the year 2. Okay, so what if the forecast is for 40,000 in the second year and onwards, and what is my break-even point? So a very basic question, I would say, but to read it in the question in examination hall is a very tough and challenging thing. There will be a lot of information, but if you pick up whatever is exactly needed in the answer and put it in a simpler way in your answer sheet, it will take about a minute, but that will solve your anxiety. Yeah, so now cost based benefit analysis I'm doing at a level of 10,000 units, at a level of 20,000 units, different level pay. This is S, machine number A, machine number 2, machine number A, machine number 2. So I'm just checking for year 1. Should I see, just now assuming that just now I started my manufacturing, and year number 1 there is a capacity of only 10,000. Is it right to make a decision now? Because from year number 2 I'm expecting my sales will be 20,000. Okay, so I'm doing separately for year number 1, separately for year number 2, and again within that also separately from product vendor X and vendor Y. Okay, so if I outsource from external market, simple, you pay 8 rupees. Fine. So 8 rupees multiplied by how many units you will sell in the first year? 10,000. 8 into 10,000, 80,000, 80,000. Very clear. Second year onwards, I'll be making 20,000 units. 20,000 multiplied by 8, 1,60,000, 1,60,000, year number 2. That's fine. Now, if I manufacture in-house, what all I will be incurring? Variable cost 4 rupees, 5 rupees. It's given 4 rupees here, 5 rupees here. So that way 4 rupees multiplied by 10,000, 40,000, 50,000. Very clear. And then depreciation, excluding depreciation, they said it. So you need to calculate depreciation separately. What is the depreciation? 3 lakhs divided by 10. So 30,000 will be here, 20,000 will be here. Okay. So 12 lakhs divided by 10. Okay, that is very simple. Now coming to the fixed expenditure, 54,000 in the year 1 for X and 28,000 for Y. So that way I got a total cost of 1,24,000 and 98,000. Okay, now it's time to take a decision. While taking a decision, if I outsource 80,000, if I outsource externally, I will be just paying 10,000 units multiplied by 8 rupees, 80, that's it. But if I do it internally, I am incurring more. So while taking a cost decision, I will go with the least cost. The least cost is 80. So in the year number 1, I should go with the outsourcing. Same for second year onwards. This is year 1, this is year 2. Again, second year we are planning or estimating to make a sale of 20,000 units. 20,000 multiplied by 8. So we know what is the sales. And for manufacturing, we require variable cost, 4 rupees and 5 rupees. Just multiply like that. Same example. Okay, so there is not change. Okay, there is no change. Variable cost will not be will be changing with a number, but remaining will keep saying will remain same. So you know what is the variable total cost if I have to manufacture 1,64,000, 1,48,000 for vendor Y. or Z here. So which is the least one? The least will be this one. So 1,48,000. So for year number 2, it's better that I purchase a machine from J and manufacturing internally. And they said that what is a what if the second year you are estimating the sales to be at 40,000. How does it make a difference? Same logic only, right? So if you outsource it, 40,000 units multiplied by 8. If you manufacture 4 rupees is a variable cost, again multiply with the number of units, 40,000, depreciation will remain the same, fixed cost will remain the same, again you take a decision. So 72,000 you are saving. How you are saving? 2,44,000. This is better. Hey, J was better here. Now here X has become better. Okay, so now you are saving here. Is there anything? Yeah, so they're again asking what is a break even. So at what break even, at what level the decision to go with either of the machines will not make any difference. At what unit level. Okay, so 54,000, 30,000, they both are given here. For product X, you see 54,000 is a fixed cost, 30,000 is a depreciation. So these are all fixed cost. Variable cost, we don't know at what level, right? So the level you assume it as X. Okay, so variable cost per unit is 4, and for Y 20,000, 28,000 fixed cost, and you don't know what is a level, so you assume the level as X. So 5X, because the variable cost is 5 rupees in the case of J. So now you just do the mathematics here and there. So X is coming as 36. So these things I'm not telling, I'm sure you will be knowing. If I'm purchasing it from X, you just one equation. If I'm purchasing it from Y, another equation. You at levels, you both the levels are same only, right? So you need not say here I'll consider it as X, here I'll consider it as Y. Not required. Here also X, here also Y. Fixed cost, fixed cost. Here you take the fixed cost, here you take the fixed cost. Variable cost multiplied by 4, variable cost multiplied by 5. You just do the mathematics. You'll say 36,000. At 36,000 units level, the decision to go with either X or Y will not make any difference. That is indifference point. I'm going with a few important questions as time is also a little less. So this is a transfer pricing question, and you can expect this kind of a question, especially in CA final. They used to give it for 8 marks, and I'm sure here also in CMA final they would be giving it for 8 or 6 to 8 marks depending upon the pattern. So now the questions are very interesting if you really understand costing and you love the questions also. I love this chapter, transfer pricing. If anybody wants to solve more questions, there is another channel wherein I made a lot of videos on transfer pricing, costing videos. You can watch them also simultaneously. It will give you the immense understanding. Though the concepts are, though the video is 4 to 5 years old, but still those videos remain relevant even today, because the concepts won't change in costing. Yeah, so there's a company AB Limited. Within that there is a division alpha and division beta. Alpha is like a one cost center, another cost center. Okay, so alpha is manufacturing one component. That component they will transfer it to beta. They will sell it in the open market. Okay, so 2:1 is a ratio, which means that if two outputs of alpha will become one input for beta. Okay, so 2:1 is a ratio. Capacity is 20,000, so they can maximum produce 20,000 units, and the transfer pricing is 200. So transfer pricing means selling price between the divisions, is you call it as a transfer price. So alpha will be selling this product to beta at a 200 rupees at the moment existing. So variable cost is 190, fixed cost is 20. This is for the alpha. Coming to the beta, they also have the fixed cost, they also have the variable cost, they also have the selling price. So here we are calling it as a transfer pricing because that is within the company and between the divisions. But when you're selling it to the open market, you're calling it as a selling price. One more thing you need to remember is when I say variable cost, it's variable cost within alpha beta only, but whatever the components they got it from alpha, that will be separate. Okay, that is excluding. It is given in the question also. Mostly it will be given like that only. So now the question is you can make additional investment of 15 lakh, and with that the capacity will become 40,000. At the moment the capacity is only 20,000, right? So now you can increase your capacity of the alpha to 40,000. So what they can say, existing I'm selling it to my friend or my brother, beta 20,000 units, I continue to sell it at 210 rupees, and the remaining 20,000 I'll sell it in the external market at whatever the price that is given in the market. Fixed cost will be 1 lakh. That will be the decision, okay, you need to make. And now the proposal to increase the selling price to transfer price to 220. What does it mean? Sir, existing they are alpha is selling it to beta, alpha is selling it to beta at 200 rupees. So they are saying, sir, market mein 210 rupees I am able to sell. Why should I sell it to you at 200? I want to sell it at 220. Because I also want to earn profit. I am also independent division. I also want to be a good profit making unit. So if I close this entire alpha, I can rent out this premises for 3 lakh rupees per annum. So why you want to manufacture in alpha and give it to beta, and there is a fight? What is a transfer price? You better purchase this component directly from the external market. Maybe they'll sell it at 220 rupees. It's fine. Okay, whatever the question will give. Outside 210 rupees. Okay, outside me you are finding it at 210 rupees only. Why should I purchase from you at 220, man? I'll purchase in the market only at 210 only, right? So alpha, I will close that division. I will rent it out that premises for 3 lakh rupees. Now you make a decision. Okay. Yeah, so this is a very interesting question. One question you understand properly, all questions will remain the same, more or less, like 5% little bit trickiness will be there, remaining all same. First is rented out and buy open market. See, telling to beta, I will not sell it to you, I will close my business, or alpha only, I'll say I'll rent it out for the external market. You purchase it from the external market. Okay, so if that is the case, first you understand what is the existing. For any question, see, by now you might have understood this logic of how I'm solving it. First you understand what is the existing situation, be it's marginal costing, be it's product mix, or whatever. What is the existing? At the moment the capacity is only 20,000, it is 10. Sir, how come 10, sir? Because 2 units of alpha will become 1 unit of beta, right? So only 10,000. Selling price 200. Sir, you said 210 is proposed. Existing is only 200. Here it is 1500. It's given in the question. It's somewhere there. You need to know what you need to pick in the question. That's it. You need to know what is my existing profit for each division. You know, sell units, you know, selling price, you know, variable cost 190, 200 is given in the question. But for B, it is a transfer price of alpha will become the variable cost of beta. Remember this point or understand this properly. This is a brother. Okay, I'm selling it to him, so I'll call it as a transfer price. So he will have his own variable cost plus whatever he's paying to me, that is also will become a variable cost. One more thing important here is 2 units of alpha is becoming 1 unit of beta, which means I need to multiply it by 2. If you make this mistake, no, entire answer is wrong. Even 1 mark also doubtful, you will be getting it. So you go know what is your variable cost, you know what is the contribution per unit, and then you know what is your total contribution. What is your total contribution, sir? Number of units multiplied by contribution per unit. Number of units multiplied by contribution per unit. You know your total fixed cost, you know fixed total contribution, you know fixed cost given in the question somewhere. Okay, so you know profit or loss. So unnecessarily 2 lakh loss alpha is making. Hey, what are you doing? Because you are selling it at lower than the market price. So you cannot blame them also. That is the reason why they are saying, I don't want to sell it at 200 rupees transfer price. I want to sell it at 220. That's what they are saying. So proposal mein what they are saying, I want to sell it at 210. Huh? Okay. What is the alternate option number 2? Let's see. Okay, now alternative 2 is, anyway you are incurring loss, right? You close your business, I'll purchase it from outside. Okay, that's a option of the beta. So we already calculated, they will sell 10,000 units. 1500 is what? The selling price. So variable cost 210, they purchase it at 210 in the open market, 2 units. Though you purchase from alpha, though you purchase from outside, the ratio will be same. So 210 multiplied by 2, and they have internal variable cost. Other than that, So total contribution per unit is 380. So multiply with the number of units, you will get the total contribution, fixed cost, profit 18 lakhs plus, because you are closing out alpha and renting it out to outsiders, you will be getting a rent of 3 lakh rupees per annum, so which makes it 21 lakh rupees. Okay, so earlier you are getting 18 lakh current profit, now you are getting 21 lakh. Simply what they are doing is, see, whatever they are making a loss, you forget, because eventually it is a company. Okay, whatever is a transfer pricing, at an individual level, at a division level, someone will incur loss, someone will incur profit, or at a higher or lower, it's only it's a game between these two. But at a company level, it will be same only, right? So option number 1 and option number 2, there's only slight difference. You are selling it, you are renting it out and getting a 3 lakh rupees, right? So 18 plus 3, 21 will be your overall profit. That is the shortest way, but don't write that in the examination, write it in a proper way. Option number 3, alpha will sell outside at 220 and beta will buy at 210. So now they want to increase the capacity. They're saying, I'll increase the capacity. Okay, what you are saying, 210 is a market price, so I'll sell it at 210. Outside I'll sell it at 220 because maybe they are having some premium, but that is a question. Okay, it's not my own interpretation. So already they got a profit of 18. So now because of this, what is the additional profit? Additional profit, selling price is 210. Already we identified, right? What if you sell it to the beta, that we find it, we don't no need to do, it's a waste of time in the examination. Additionally, what you are doing, you are selling in the open market also, so you are selling it at 220. Variable cost is given, okay, already given in the question. So you know what is the contribution, you are selling 20,000 units, so 6 lakhs is your profit, and 4 lakh is the additional investment you will make for this. So 2 lakh is the additional profit, 18 plus 2, 20 is your profit. Okay, so that is your hey, option number 2 is, what is the option number 2? Already 18 lakhs we got it from the B. So if you send it to outsiders, you will get 2 lakhs. Okay, so it's not increase in capacity. So this is a problem, not having a proper question. Now come to the fourth option. Increase the capacity at 12% capital employed. You increase your capacity. What do you do when you increase the capacity? You sell in the open market also, you sell to the beta also. Okay, so outside you will sell 20,000, with beta you will sell 20,000. Outside 220, beta 210. This is given in the question. Okay, so alpha will have two types of two columns. One column is for internal, one column is for external. Okay, 220 is the selling price, 210 is transfer price. Here we will sell it at 1500 as a case. Variable cost 190, 190 is same. B you are selling it to beta, B you are selling in the open market, the variable cost will remain same. And for them, they'll purchase it at 210. So because 210 is the transfer price, 210 multiplied by 2, and they will have their own variable cost. So contribution per unit, we got it for 3 scenarios. One scenario, alpha is selling to outside. Second, alpha is selling to beta. Third, beta is selling in the open market. Okay, so that you multiplied with the 20,000 here, 20,000 here, 10,000 here. So you'll know what is the total contribution. Fixed cost for outside, you are incurring additional cost of 4 lakh rupees, and for transfer pricing internally 1 lakh, it's given in the question. Fixed cost will increase by 1 lakh. So fixed cost will increase by 1 lakh. So you are getting a total profit here. So total it is coming to 5. Okay, they are incurring additional capital of 4 lakh at 12% interest. So 1 lakh 80 will be included here. So profit is 2 lakhs if you are selling it outside. Transfer pricing, it's outside. Total 18 lakh. So 21 lakh 20,000 will be the overall profit of the company. Okay, so it's a very nutshell I am trying to explain. If the alpha is giving it to outside the market, they are making an additional investment. For additional investment, you will have interest component, that is here. And because you are increasing the capacity, there will be increase in the fixed cost also. For that, this will be the fixed cost additional investment. Okay, so have the question in front of you. I just try to explain the concept, not try to solve it here, as that is not our intention. So now there is one more question. Here in this question, we will try to fix the selling price of a particular product. Okay, so what they are budgeting is they want to sell 1 lakh units. Variable cost is given, fixed cost is given. Finance director is coming and saying we will approach the cost plus model. Whatever is the cost, you add 25% of it. This is like very foundation level question. And the marketing manager or director is coming and saying that I will give you a brief of various levels. Like if I want to sell it at this rate, what will be the quantity I will be selling? If this rate, what will be the quantity? So they have a scenario thing. So they will select the best out of it. So now for us, we need to calculate once for finance director, once for marketing director. Finance director's question is very simple. Variable cost is given. Variable cost 10 rupees. Fixed cost per unit 6 lakhs divided by total number of units 6. So you are getting a total cost of 16. He's saying 25%. He wants to add 25% of 16 will give you 4. So 20 will be the selling price. So that is the selling price. He is suggesting it. So as per the finance director. Okay. So now marketing director is saying that no, don't go with that. I will say if you keep the selling price at 18, you will sell this many units. If you keep it at 20, you will sell this many units. Like the scenarios you find out separately. Again, this is more of a calculation related question than the concept related. So now all scenarios you take it. You know what is the contribution per unit. We know the cost, right? Already we got the cost. Variable cost. Okay. So only variable cost, we require the contribution per unit. So you know what is the contribution per unit and how many units you will sell, that also you know. Multiplied, you get the total contribution, and minus fixed cost, you will get the profit. So why did I not take 16 directly? Because that will not change based upon the quantity, right? That's a very basic. So where you are getting the most profit, 2.96 lakhs profit is you are getting when you are selling this at 24 rupees and 64,000 units. So as a finance director said, if you keep it at 20, you will end up getting a profit of only 1.6, but here you are getting more profit. So marketing director is correct in this case. So there is one more question. Catering services 30 days, like someone is trying to sell some food. This is, I find this question to be a little interesting. Listen. So for making that food, they are incurring costs and packing 100 per meal. Selling price 160. So selling price is 160, and to prepare that food, they are incurring 100 rupees. Delivery charges 120 per delivery. Okay, so delivery boy will come to take one meal. He will charge 120, maximum 10 meals. So once he comes, he can take up to 10 meals. Okay, one delivery. See, whenever you order from Swiggy or Zomato, delivery charges incurred only for once, right? You can order 4 foods, 5 foods, different flavors. Like that, in this question, they are saying I can accommodate maximum 10 meals, but I'll charge only 120 per delivery. Fixed cost is given. So now what is the break-even point? So break-even point, the very purpose of the break-even point is there is no profit, there is no loss. Okay, so when you want to avoid the loss, what you need to say is what is the optimum delivery quantity. Okay, so if I'm selling only one meal, so the guy will take 120, which means in my bill I will write 120. So unnecessary I am incurring more cost simply because my order quantity is less. It's like optimum order quantity. Okay, here optimum delivery quantity. So optimum is maximum, he will take 10, right? So you design your sales in such a way that you send or sell all 10 at once, so that the delivery cost per order per meal will come down. So 120 for 10, which means 12 rupees per meal will be the best optimal cost. So selling price 160 given, costs they are given, delivery charges 12 rupees. I said we are assuming, or we want our delivery guy to take 10 meals at once. So costs per unit, cost contribution per unit is 48. Fixed cost divided by contribution per unit will give you the break even point, 3000 meals per month, but we want it in orders, right? So each order he will take 10 meals, so 300 orders if he takes in a month, that will be the break even point for this particular business. So now they are saying, what if I make 5000, what will be 5000 meals, what will be my profit? Okay, so just now we calculated what is our contribution per unit, 48, 5000 number of units, contribution per unit, so 2,40,000 is the total contribution, fixed cost is given, so you got the profit of 96,000. Very basic, 1 mark if it comes, you can do it. Now they are saying what is the worst profit at 5000 meals? Okay, what is the worst profit? How can you use the word worst? So worst means that for here the game is all about the delivery guy only. If you are sending 10 meals, no, our delivery charges are very less. If you are using only 1 meal, no, it will be more. So we will take the worst scenario. So worst scenario will be 1. But question has given, I did not write the complete question, right? Question mein they said is minimum meals is 3 for this particular piece, not for the entire question. Okay, 3. So which means that 120 is the delivery charges. So you will take 3 meals. So 40 rupees will be the delivery charges. The worst scenario. So I know what my variable cost already is given in the question. Now delivery charges 40. Yeah, 40, because I am assuming it's only 3 meals. So 140 will be my costs. So contribution will be 160 minus 140, 20. So like that I will make 5000 meals. So 1 lakh will be my total contribution. Fixed cost is 1,44,000. Loss will be 44. The worst profit I will get is 44,000, because you are not properly utilizing your delivery thing. Now we'll come to the next question. Fixing the selling price. Okay, is just time sufficient? So very lengthy question, but still I would end up and solve this question. Hope you will understand. You try to understand. It's very lengthy and it's very interesting also. Hopefully it should not come in the examination, because it's such a lengthy question. Okay, there is one company. They are manufacturing 2 products, A and B. A 1 lakh units, B 2 lakh units. They have given direct material, direct labor cost. They are expecting 20% as a return on capital employed. Labor hours rate is 3 rupees. So per hour they are paying 3 rupees. It's all question, no interpretation. Factory overheads 50% is a fixed, which means 50% is a variable, which is 100% of direct wages. Okay, whatever is the direct wages, 100% will be my factory overhead. Out of that 100, 50% is fixed, 50% is variable. Administration overhead is 10% of factory cost, 100% fixed. Here cost sheet understanding is very important. I hope you are aware of how the cost sheet will come: direct material, direct labor, direct expenditure, prime cost, factory overhead, factory cost, then administration overhead, cost of production, and then selling and overhead, cost of sales. Like that structure is need to be clear. And selling and distribution, 50% is variable, 3 rupees and 4 rupees they are given separately. They have a capital investment of 50 lakh rupees, working capital of 6 months of COGS. They have a term loan of 14 lakh, which they are paying at 14%. Bank loan of 50% of working capital, 18% they are paying as a interest. Okay, so now the question is, fix the selling price, but the contribution per direct labor hour should be same in both the cases. Contribution per direct labor hour, again it's more like our product mix question. Contribution, generally what we do, contribution per unit we do, but here contribution per direct labor hour, how many labor hours you use, that should be same. Okay, contribution per direct labor hour should be same in both the cases. Statement of profit. Okay, it's a very interesting and very lengthy question. Let's try to simplify as much as possible. Okay, so here always go with the cost sheet kind of a mentality. Direct material is given, direct labor is given. With that you start, and in this they have given lot of information, right? You keep adding one by one, you arrive at the cost sheet. Okay, So that's what I will be doing it now. Direct material is given, direct labor is given, both you add, it will give prime cost. Factory overhead 100% of direct labor. Okay, so which much is, how much is fixed, how much is variable, not important at this point of time. Okay, we'll do that little later. So 100% bole to 9 rupees 6 rupees is the direct labor. 100% of that will be again 9 rupees and 6 rupees. So 32, 33 and 26 is your factory cost. Administration overhead is 10% of factory. 10% bole to 3.3, 10% bole to 2.6. Now you got the cost of production. For that you add selling and distribution. This structure is important. 3 rupees and 4 rupees separately again given in the question. So 39.30, 36, 32.60 is the cost of sales. I hope this is like a step number 1 in our entire question. Now this may say you just find out what is your only variable cost. Why we require variable cost? Because somewhere in the question they said that the variable contribution per direct labor hour should be same. So when you want to find out what is the contribution, first you need to identify what is your variable cost, right? So variable cost is prime cost, till prime cost everything is variable. 24 and 20, yeah, 24 and 20 everything is variable. Again in this said factory cost may 50% is variable. So factory cost, how much we got? Factory cost 9 rupees and 6 rupees. Of that 50% is variable. So 4.5 and 3 is variable. So 4.5 and 3 is a variable. And administration may they said selling 50%, again this is also variable. 3 and 4 may 50%. So 1.5 and 2. So 1.5 and 2 is a variable. So you are getting total variable cost per unit. So now you got variable cost. You somewhere in the question they have given the selling price. Now you get the contribution per unit also. Okay. So selling price is not given. Huh? So we need to do the reverse calculation here. Okay. So COGS we got it 39.30, 32.60. You remember including variable cost. We prepared one cost sheet. $39.30, 32.60. That is the total COGS, total cost of sales. So 39.30, 32.60 total cost of sales. 1 lakh units of A, 2 lakh units of B. So that will be giving the total cost of sales. And they said that we require 20% of as a capital employed as a profit. So 20% of capital employed. So what is the capital employed? Somewhere we have prepared. Fixed capital 50 lakhs given in the question. Working capital may they said 50% of the cost of goods sold. Okay, so 39.30 is the cost of sales. 50%, 1 lakh units you will manufacture, divided by 2, 50% given in the question. Okay, for B 32.60 is the cost of sales, multiplied by 2 lakh units divided by 2, of 50% only they said it. So this is a working capital. So total working capital you got it, total capital you got it, including total capital requirement. So total capital employed you will get it, and you require 20%. So 20,45,000 is what you required as a profit. So 20,48,000 is what you required as a profit. So it's a working note. So this should be your total sales between two products. Okay, so 21 crore 24 lakhs 95,000. So this is the total sales. What we will try to do is we will try to eliminate variable cost. So variable cost is 1 lakh units 30 rupees, 2 lakh units 25 rupees. So you will get required contribution. So from the required contribution they said it should be same, right? So contribution per hour. So how many hours they are using? Contribution per hour. Direct labor they are given 9 and 6, right? And somewhere in the question they mentioned this one point, I highlighted also, labor hour rate is 3. So labor hour rate is 3, which means that labor hour rate 3 means how many hours you might have used for one product of A. 3, 9 by 3, 6 by 3, 2. Okay, so it should be 5, right? 5, how come you got 7? just hold on. Okay, so number of hours. So we got 3 and 2. Somewhere I wrote, no? 3 and 2. Oh yeah. So we require 3 hours of A, 3 hours for product A, 2 hours of product B. We are manufacturing 1 lakh units of A, 2 lakh units of B. So we totally require 7 lakh units. So we got what is the contribution, total contribution we required. We know what is the total number of labor hours we required. Sir, why are you doing this point? The only sentence that prompted us to do this is they wanted contribution per direct labor hour should be equal. So because they wanted it to be equal either for A or for B, we are doing the total contribution divided by total number of hours. So that way we are getting 6.4214 should be the contribution per unit. Okay, so 6.4214 multiplied by 3, because you are using 3 units, 3 hours multiplied by 2, it's for 2 hours. So 19.2643, 12.488428, that should be the contribution per unit. So this is labor hour, contribution per labor hour, but how many hours you are using? 3 hours, 2 hours. So now we got it, contribution per unit. Okay, so this is only the contribution per unit. So 19, and this is the contribution. Variable cost separately we got it, variable cost. Now you will get the selling price. So what is this selling price? See, generally what we do, the question is like such a tricky question. Selling price minus variable cost, that will give you contribution. So now we got the contribution per unit from the reverse calculation. Now you know variable cost we calculated earlier. So with adding these two, you are giving what is the selling price per unit. So that way you do this statement of overall profit, like selling price multiplied by number of units. Okay, again COGS, interest they said somewhere, they said no, 40 lakhs investment, 14%, working capital ke liye 50% of 18%. So you are getting this profit. This calculation is simple, but understanding the context was more trickier. I hope this revision will be helpful for you. See, if you find these kind of videos are helpful for you for your preparation at the last moment, please let me know in the comment section. That will be helping me in making and coming back with the more videos. Thanks for watching. Have a nice day.